Good morning, and thank you for joining us for our WealthPoint WP90X. It's 90 minutes of extraordinary education, and we're going to do our best to fulfill that promise and make sure that we deliver on it. Before we get started, I wanted to introduce my two counterparts. First is my partner, Michael Kenneth, who's president of WealthPoint and also CPA and head of our solutions team. Michael has been with the company for 11 years now, almost 12 years, and is one of the brightest young minds that I have ever come across, and very blessed to be working with him. And also with us is the esteemed Kristin Williams, who's a senior vice president of advanced sales with NFP, and I have the pleasure of working with Kristin in the PartnersFinancial community, and she is an incredibly valuable resource due to her knowledge and background and experience around all things estate, business, and tax related. So thank you both for agreeing to do this webinar with me. And of course, my name is Ryan Barradas. For those of you that don't know me, I am the managing partner of WealthPoint and the least credentialed individual on this panel, but hopefully will provide some entertainment factor and some color along the way. So before we get started, we've got a few housekeeping items that we need to go through. The first is just to review the learning objectives. So first, we're going to provide an overview of Internal Revenue Code 6166 and go through what it is, what it isn't. We'll define the unintended consequences when utilizing 6166, identify client solutions where it should and shouldn't be considered, and then evaluate various alternative strategies to pay estate taxes. So we're going to go through a case study where we look at using cash, using debt, bank financing, using 6166, and also using insurance, because there's more than one way to pay an estate tax once it's due. In terms of Q&A, we would prefer that you use the Q&A function, which is just to the right of your participant button at the bottom of the screen. Please don't use the chat function. Michael Kenneth will be evaluating or watching the Q&A and keeping notes and aggregating questions, and he will potentially interrupt the presentation midstream, but we'll also be saving most of those questions for the end unless it's appropriate to address it right then. That's why I'm not in charge, because I would be addressing everything right away, because ADD will get the best of me. And then if you'd like CE or CFP credit for attending the webinar, please send an email to Kristin Teff. It's Kristin at wealthpoint.net, not Kristin Williams, but Kristin Teff, our Kristin. And please include the following information: your name, the type of CE that is needed, and the license number. The last thing is, as a part of the CE and us being able to provide CE for all of you, we would like you to create or complete the post-webinar survey in order to receive that CE credit. And that survey link is going to be emailed to you after the webinar. So without further ado, I am going to turn it over to my partner in crime, Mr. Michael Kenneth, and let him begin the presentation.
Perfect. Yeah, thanks, Ryan. And thanks, everybody, for joining today. Really appreciate it. To get started, we're really going to just kind of set the foundation for estate taxes and 6166, and then dive into a little bit more deeper information on some of the concerns and how it's utilized and some actual fact patterns. But to start, just wanted to kind of provide a real high-level overview of estate taxes, both exemptions and estate tax rates. So both of these charts that we have up here look at the estate tax exemption and the estate tax rates over the last roughly 25 years. As you can see, the exemption amount has steadily increased over time. 25 years ago, it was 250,000, 500,000, up to $1 million, $2 million, and then at today's rates, it's currently $12.9 million per person from an estate tax exemption amount. On the estate tax rate side, as you can see, rates have slowly decreased over time, substantially decreased for those of you that were paying attention to estate tax rates in 2010. But over time have slowly decreased, and they've actually remained at the 40% rate over the last 10 years. Keep in mind that from an estate tax perspective, estate tax applies when the value of an individual's net worth is above the available estate tax exemption amount. If anybody has an estate or a net worth that is less than this exemption amount, there's no estate taxes that are needed. If you have a net worth that is higher than that amount, then you'll be subject to estate taxes. The other comment I wanted to make is current estate tax law, it provides for a sunset of the exemption in 2026. So beginning January 1st, 2026, the estate tax exemption amount will effectively be cut in half. It will revert back to the 2017 tax rates. That was part of the Trump tax cuts that took place in 2017, extending for 10 years, and then will sunset. From an estate tax calculation perspective, I think a lot of you that are on the call today know and understand how to calculate estate taxes, but just want to set a quick foundation of that. This example here, we look at Adam, who has $100 million net worth. When we look at calculating his estate tax, we first need to come up with what is the size of the taxable estate. When we look at Adam's assets, they're made up of various things: marketable securities, cash, real estate, operating business, etc. Certain assets are subject to discounts. These discounts are things like minority interests. So if you own a partial interest in an operating business or a real estate asset, or things like lack of marketability. When you look at assets that have a publicly traded market to set the price, like publicly traded stocks, bonds, those types of things, it's very easy to determine what is the fair market value of that asset. You can look at the closing price for that stock, and that's what the value is of that asset on that given day. But when you look at other assets that are privately held, like operating businesses, real estate, it's more difficult to determine what is the fair market value of that asset as of the date of death. And so what ends up happening is that there's a valuation expert or professional that would be engaged. They would determine the fair market value of those assets that are tough to quantify or tough to determine what that value is. And they would also factor in various discounts like minority interest, lack of marketability. Typically, those discounts can range from 15 to 45%. It really just depends on the character and the type of the asset, as well as the overall entity structure for where that asset is held. Again, in this example here, we're looking at $100 million net worth. We're backing out $25 million for applicable discounts. You can see that's calculated based on 33% of the $75 million operating business that Adam owns. So his taxable or his discounted value for his estate is $75 million. We back out the estate tax exemption that's available to him. Again, this assumes that he hasn't used any of his exemption during his life, and it's saved it all for passing, at death. If he used any of it during his life, we would back that out from the estate tax exemption amount, coming up with our taxable estate, and then estate taxes at a 40% rate. So you can see here, Adam's assets begin at $100 million before he passed away. And then after we factor out almost $25 million of estate taxes, the remaining amount would go to his heirs or to whoever he chose in his estate planning documents. But we just wanted to set that foundation from an estate tax calculation and what estate taxes really are, so that we can really dive into Section 6166. For those of you that don't know, Section 6166 is effectively an installment plan that allows for a deferred payment of estate taxes that are owed upon the death of a U.S. citizen. That election, you have to notify the government, you have to elect that you're going to utilize Section 6166. That election has to be filed no later than the due date for the estate tax return. So this isn't something that you can choose to do years later. You actually have to do it upfront when you file the estate tax return. And the big factor of 6166, or one of the most important factors, I should say, is that it's only applicable where the value of the deceased ownership in a closely held business interest is more than 35% of the adjusted gross estate value. There's a couple of key factors there that we'll talk through in determining that. But effectively, what that means is that your business has to represent more than 35% of the value of your estate. If it doesn't represent more than 35%, you're unable to qualify to utilize Section 6166. So a couple of key terminology there in order to determine, do you qualify, or does that estate qualify for this option? First one is, what is the adjusted gross estate? And that's really the gross estate less deductions for expenses, debts, taxes, and losses. So we're backing out any sort of outflows, if you will, from the value of that estate to determine what is the adjusted estate value for purposes of determining that 35% threshold. The other important factor to really define is, what is a business interest? There's a few factors associated with that. A business interest can be a sole proprietorship. Obviously, if you own that business and it qualifies as a sole proprietorship, that qualifies as a business interest. It also would mean a partnership, partnership structure, LLC, or a corporation, as long as you own, or the deceased owns, more than 25% of the total capital interest or more than 20% of the voting stock in that corporation or in that entity. Effectively, what it means is that if you can't have a very small minority interest and then qualify that as a closely held business interest. The other factor there on the business interest is that it must be an active interest. It's very clear that passive ownership does not qualify when determining what is a business interest. So we'll keep that in mind as we go through some of the further concerns and aspects of 6166. Yeah, Ryan, did you want to say something there?
Yeah, Kristin, I wanted to ask you a question. I'm sorry to put you on the spot, not unplanned, but in terms of the definition of a active interest, or the difference between passive and active, I know this is a little bit of a fuzzy area. It's not 100% clear in terms of the services definition, and largely dependent upon the arguments made by the counsel for the deceased estate. But maybe can you touch on that a little bit, because I know there's no hard and fast rule. There are some fuzzy gray rules, so to speak.
Tax lawyers, we love fuzzy gray rules. Yes, there is no real clear definition. It's very much facts and circumstances. But so what you're going to need to do, look at the underlying business. I think a lot of times, sometimes it's very clear that you have an active business, you're making widgets. That's easy to say, yeah, you have an active business. Where it gets very squiffy is, say you're managing a portfolio of real estate. There's a fair amount of case law where they'll look at the facts and circumstances of the individual situation and say, yes, this was active, no, this was passive. So the service generally hasn't defined what truly makes something active, but it's a facts and circumstances situation. I think for these purposes, it is important to kind of have a sense going into this about whether your business is going to qualify as an active business if the 6166 is something that's on the horizon for you. So, I would say that well before the decedent's death, there should be a pretty good idea of whether or not you're going to qualify as an active business.
Perfect. Thank you.
You're welcome.
Hey, Kristin, we're going to put you on the spot a lot today, so I hope you're ready for it.
I'm ready.
We had a question actually that came in relative to active interest. The question was, if the LLC member is not the manager, but does participate in decisions and analysis of the real estate that the LLC owns, in your opinion, would that qualify as active?
Or active enough?
Or active enough, I guess is a better way of putting it, yes.
I would think you have a fairly strong argument that you can be making that it's active enough, active adjacent. Really going to have to look at the facts and circumstances and how long did that happen. I mean, let's say it was active, the person was really involved, and then shortly before their death, they had a stroke. and no longer really had capacity. At the moment of death, they're no longer actively involved in the business, but up until that point, they were actively involved. So, the estate's going to be able to make a strong argument that absent this event that they didn't have any control over, it was an active ownership interest.
Perfect.
Okay.
Awesome. Yeah. Thank you, Kristin.
Keep them coming.
I have no doubt we will. So I hope you're ready for it. So we want to, once we've kind of established the business interest and determine the gross adjusted gross estate value, we want to talk a little bit about the actual calculation for the payment itself and the payment of the taxes. And so again, 6166 is a deferral strategy. It's a deferred payment of the taxes that are due proportional to the value of that business interest relative to the overall value of the estate. Keep that in mind, that it's only on the business interest portion. All of your other assets or the deceased other assets, marketable securities, real estate, cash, whatever it might be, all of those do not qualify for the deferral. It's only on the business interest portion. But the terms of 6166, they allow for a deferral of the estate tax, the actual principal, if you will, for up to 5 years. The initial interest payment is going to be due upon the filing of the estate tax return. And then there's annual interest payments that are due for the following years on the anniversary of that filing of the return. After that interest-only period or that initial deferral period, the estate can then pay that tax in up to 10 equal installments. You can always accelerate it. The government is more than willing to take money up front, but you can defer it out over that 10-year period. So effectively, it results from a timing perspective, results in a 4-year deferral and a 14-year payment period, because you're paying that interest effectively day one, if you will, when you file that the estate tax return. How you calculate the interest rate, it's a little complex calculation, but effectively they provide for a 2% interest rate up to a specific dollar amount of estate tax that is owed. In this case, the amount is approximately 1.7 million in 2022 and 2023. That number does adjust for inflation every year. And then the tax exceeding the 2% interest portion, so above that threshold, is going to be incurring interest at a rate that's equal to 45% of the underpayment rate. That underpayment rate does fluctuate, up and down as the IRS rules on that. Currently, that rate would be 3.15%. So when you think about it from a loan standpoint, you're talking about paying a loan at a very low interest rate, especially in today's higher interest rate environment, which, on the surface can seem very attractive as a deferral strategy, but oftentimes can come at a pretty significant cost. And that's really what we want to dive into at this point, and get into the concerns over 6166. And with that, I'll turn it over to you, Kristin. Yeah, Ryan, go ahead.
We've got a couple of really good questions that I just wanted to go back to the active. There was a statement. One was anyone will have a hard time arguing that they're active if the person is solely a member of a member managed LLC. The member has no legal right to actively manage. But then also one person asked, can we speak to whether it has to be the decedent that is active, or if it can be a child of the decedent or other family member? And it has to be the decedent or the decedent's spouse, right? That is active if there's a common death, Kristin?
Yes, that is correct.
Yeah, not a child.
Yep.
Okay.
And again, the question of active is really, as we said, it's a facts and circumstances situation. And, I think that if there's a question about whether you're active or not, then 6166 is probably not the answer for you, even if, it's an answer because of the other reasons. If there's a question about the not type of business or the decedent's involvement, another strategy probably needs to be deployed. And that.
Some people talk about the 500-hour rule or other things being the definition, but it's really, you have an active going concern that you're managing and making the decisions. Somebody gave me an example of somebody that had a large portfolio of multifamily housing properties, but then had a third-party company managing it, would that qualify under 6166? And it would be tough.
Right. I think the larger thing is it's interesting to talk about specific businesses and situations of would this qualify and would this not, but it's important to zoom out a little bit, because 6166, the IRS is not a warm and fuzzy organization. They are savvy and their job is to collect revenue. And 6166 is the Congress and the IRS's way of collecting revenue. It is not, as you come to see, generally speaking, it's not a strategy that you want to employ. It's a last resort. I don't want to liquidate my business. I don't have the liquidity that I necessarily needed to pay the estate taxes. I have to come up with something else. I mean, I'm sure you all have had clients that getting them to make a decision and finalize their documents and put a plan in place. It's easier to get them to go to the dentist and have their fingernails removed simultaneously than sometimes it is to get them to make this decision. Or there's an unexpected death. And so there just wasn't enough time. 6166 becomes the solution. So certainly this question that we spent time on with if it's an active or passive business is part of that. The other piece is that we have to look at the business itself, not just the nature of the business, but the relationship that the business has to the overall estate. First thing is we're only deferring that portion of estate tax that relates to the business itself. So your business has to be 35% of your overall adjusted gross estate. 65% of your overall adjusted gross estate is likely can be non-business assets, and those will also be subject to an estate tax. So, depending on how your estate is structured, you may still have a very substantial estate tax bill coming due shortly after death, whether you make a 6166 election or not. The other piece of it that can really trip people up is the 35% threshold. The value of the business needs to be 35% or more of the total adjusted gross estate. So, we talk about discounts. It's a strategy that we employ quite regularly in privately held businesses where you have, a lack of marketability discount, possibly a minority interest discount. If you have a really great valuation expert who establishes the value of your business and gets you a discount, that discount could actually maybe push you below the 35% threshold because your expert did their job too well. The other thing to keep in mind is that gifting, any of the other estate planning techniques that you're using may push you outside that 35% threshold. Or let's say you, mined Bitcoin in early 2000. All of a sudden you had all these cryptocurrencies. Unexpectedly, that became a really high portion of your overall estate. Now your other assets are such that your business no longer really meets their 35% threshold. So when you're thinking about 6166 and doing additional planning, this 35% threshold can be a real issue. It will, as we said, it can disincentivize future estate planning and wealth transfer strategies.
So where is that safe place to stop? That becomes the question, right? And what you just talked about, it doesn't have to be Bitcoin. It could be investment in a startup company. It could be a private equity portfolio. It could be speculative real estate that all of a sudden explodes in value, which is great news from an investment perspective, could be horrible news from a 6166 point of view. So the next slide, I think, really talks about that.
And that is particularly true if the plan is that you're going to use 6166. So again, it's a difference between, are we actively planning to use 6166? Because that may or may not be a good idea. Or is that our last resort choice? And if you're actively planning to use it, then that question of where do you stop really becomes an issue. And this chart, to your point, Ryan, really helps to drive the question home. So we were saying in this situation, in our example, the ideal scenario is a 45-55 split between the operating business and the other assets. just to give you some cushion to take care of some fluctuation in value. You can have a small depreciation in the value of the business, and all of a sudden you drop below the 35% threshold. And in this example, we're just barely under it, but the service doesn't care. If you're under it, you're under it. And being 0.1% under isn't going to really, it's not going to help you. It has to be at least 35% of the overall estate. So fluctuation in your asset value, asset situations where your planning is more successful than you anticipated, the business value is declining, the other assets are increasing. All of these things can jeopardize your ability to take advantage of 6166 if you have spent years thinking that's going to be the answer to your estate tax question.
But all of these things, the first two assume that the other two asset classes stay static.
Right.
The more likely scenario is one moves one way and one moves the other way. And that's the perfect storm. They don't have to move very much, and all of a sudden it throws things out of balance. And we have to really put ourselves in the perspective of who would be using this. And they're the people that avoid good quality estate planning, right? They're kicking the can down the road. And so what happens when people get much older is they don't cede control. They don't do proper succession planning. Maybe they lose the interest of their adult children. And the business value could depreciate in value, and now they don't have good planning done. They've not bought any insurance. They've been relying upon a strategy that may not be valid anymore. And so it's really important to understand when we're looking at this, the mindset of the individual that would ultimately be electing the 6166 or making the 6166 election.
And also, Ryan, I would say that, and you've bumped into this as well, there's possibly this notion that it's also just a viable strategy as it is. The IRS gives you the opportunity to defer your estate tax, stretch it out, pay it on sort of a ratable basis over a certain number of years. Why not take advantage of that? They're giving you this option. Why not do it? So sometimes I agree that we just didn't get there fast enough. We didn't get the plan done. But then other times there's a notion that 6166 could be just a great strategy. And that's where we really want to dive into the things you need to be aware of when you're thinking of using 6166. So the first thing, we all love to be able to deduct interest. Take a loan and deduct the interest, and can't tell you the number of times I get asked the question, well, can we deduct the interest on this or this type of loan? So I'm going to say right off the bat, you cannot deduct the interest on your 6166 installment note payments. Also, the interest rate over the 2% is going to adjust annually. So, right now, sure, it's a pretty low rate compared to where we are, but that's going to adjust annually. And as we've all seen in the past year, interest rates are unpredictable at best. You have to pay them on time. There's no wiggle room. The IRS is only allowing you to defer your estate taxes because they'd rather get your money over time than not get it at all. But if you're late at all, they're going to trigger an immediate acceleration of the entire balance remaining on your note. Also, if more than 50% of the business is sold, the loan will be called. So so many times there's this, once dad dies, we're just going to sell the business. It'll take us a little while to find a buyer and get our feet under us, but we don't want the business. And when dad is gone, we're going to sell it. That will immediately trigger the loan to be called, and all of the outstanding estate tax will be due at that point. So if there's a super secret plan to sell the business as soon as dad is gone, then 6166 is not a viable option, because there's no point in doing the deferral and then having that loan be called.
Real quick, somebody asked if could they pay more than the interest payment, and that's something that we did address earlier. You can always accelerate payment of principal. It's just the minimum required payment is interest only on the balance. And so if you were to pay down some of the principal, the minimum required payment would then be interest only on the adjusted balance for the principal reduction. Sorry,
Right.
go ahead, Michael. Next.
Yeah, actually, you had a quick question as it relates to the last bullet there, Kristin.
Mhm.
50% of the business is sold, the loan is called. What if the business is transferred? What if ownership is transferred? Does it stipulate that it requires a monetization event, or let's say it was gifted to a family member in this 15-year time period?
So if we're going to maybe give it to a trust or something, that is, I would say that that's not going to trigger the loan to be called. But each year, and we'll talk about this on the next slide, each year the IRS they want to know what you're doing. They're going to look at your books. They're going to look at your returns. They're going to go into everything. So if you've made a gift of the interest in the business to a trust for estate planning purposes, they're going to see that. You're going to have to talk to them about it. They probably will, understand what you've done, even if you maybe sold it for an installment note. It's still within the family, particularly if it's a defective grantor trust and you're still the owner for income tax purposes. All of that will be okay under 6166. It's really the monetization that they're looking for, but they're going to be all up in your business for the entire time that that loan is outstanding.
There was one question that came up that I'd like to address because it's a really, really interesting question. Again, what motivated us to do this presentation is really because we had 3 people in a very short period of time looking to seriously consider using 6166 election for the payment of estate taxes. And there was a question, is there any statistics out there about how many families actually use it? And I can tell you that after interviewing probably 20 separate trust and estate attorneys, I only came across 3 that actually had a family use it. One of which had 2 families use it, and the last one that he had that used it was in 1993. But most people have never had a family use it. And it's a lot of the things, and especially as you start to see this, because a lot of our clients, especially with big operating businesses where it really becomes a question of should we use this, they have leverage. And so we'll talk about this, but very, very few families actually do. And when they do, it can become an issue, and we're going to address some of those issues here.
Ryan, I think you and I talked about this when we were creating this presentation, that when I was in private practice, I had a client use it. It was a father and son's construction company, and the father had a heart attack. They were clients of ours. We were working on putting together a plan, but there was an unexpected death, and the only option was 6166. And the business really struggled to survive. They would have struggled just because the sons weren't quite ready to take over the business. But the addition of this lien that we're just about to talk about really, really made everything that much harder. So I can concur with all of the other estate planning attorneys you talk to that it's just not a strategy that you see used if there's any other option out there.
Hey, Kristin, real quick before you jump into the collateral concerns, one last question on the business selling point. The business being sold is really at the corporate level or the entity level in terms of the ownership interest being sold. It's not that if, let's say you have an entity that has 5 properties in it, and you sell 3 out of the 5, that doesn't constitute a business meeting that 50% requirement, because you still own the entity that owns the assets, right?
Right.
Okay.
Yes.
Perfect.
I mean, you're allowed to continue running the business that you had before. So you're in a real estate investment company. You buy and flip houses, right? You continue doing that business and trying to generate as much revenue as you can. That does not, to your point, Michael, trigger, oh, we sold the business itself. Perfect. It's just, I mean, the IRS is looking for situations like where I said where, one's dad's not in the picture anymore, the kids just liquidate the business and take cash and walk away. That's where the IRS says, oh, hang on a minute. You still owe us money. Nice try, but we want our pound of flesh first. That's really where it is. And it all comes back to this notion of the service thinks, we're better off letting this business continue to run and pay off its taxes over time than forcing a fire sale. But if you sold the business, they're happy to take their estate taxes.
This next section is really coming out because of one of our clients that had a significant amount of debt leverage with partners as a part of the overall business strategy. And so then the question really became about the collateral itself. So
Yes.
Sorry, Chris.
Yeah, no, that's okay. And the security interest, that was the piece of it that was quite alarming to the client that you had. The 6166, the IRS is going to take a security lien interest against the business and its underlying assets. They want to be certain that they're going to be repaid. So, as it says here, the business stock is acceptable as collateral if you meet 3 requirements. The collateral has to be expected to survive the deferral period. So, you're operating your business, you've got valid assets. Will they still be there? Will it be sufficient to serve as collateral? The same sort of collateral sufficiency that we would make in any sort of loan situation. This is interesting. The collateral has to be identified in the agreement, and all parties that have an interest in the collateral must consent to the lien. So imagine you have a business with, 8 other owners. It's a big successful business. There's the family and then 7 other people. Everybody that owns an interest in the business has to consent to the lien because the lien applies to the business itself. So there's no more privacy. The service will be under everybody's skirt the whole time that this loan is outstanding. And so all of the parties that own interest in the business have to consent to it, not just family members. So no more privacy. And, a lot of the estate planning we do is designed to get you as much privacy as you can as you transfer assets. And then the value of the collateral has to be sufficient to pay the deferred taxes plus the required interest. This one's sort of an interesting one. I think about buy-sell agreements when we talk about a buy-sell agreement and, okay, we're going to make a small down payment and then we're going to pay the balance on a note over 10 years. That just in that small context of the buy-sell agreement can be really onerous on the business. And that's not an active lien as well. And so here we're giving the IRS a lien on the asset, but also promising to pay over a period of time. So that can be a real challenge in terms of cash flow. The IRS has the right to monitor the value of the collateral throughout the life of the lien. That's hey, we're going to come knocking every year and make sure that your business is still doing okay and that we're going to get repaid. They can request additional collateral if they need to. And if there's no additional collateral provided, then they're going to declare an acceleration of the payments. That can be a tricky situation. I would imagine you're not putting up additional collateral because you don't have any. And now the IRS is going to accelerate your payments. And can you make those payments, or will you have to be selling the business at that point? And then there will be annual audits. I'm not sure that anybody's ever had a client willingly sign up for annual audits, but here we're talking about 14 audits. There's your first estate tax return and then 14 more audits. So that'll be a lot of fun for everybody, right?
Nope.
Kristin, I'm gonna one quick question on this, and you might hit it on this next slide. The IRS lien or the loan, right? In terms of the structure, that is first position, regardless of any other debt.
I have to give you the lawyer's answer, Michael, and that's it depends, right? So the IRS
Next page.
Next page. It depends. The IRS can choose, right? Again, they're not a warm and fuzzy organization that are, looking out for you. They're looking out for themselves. So they can choose whether they want to be in first position or second. And so they're going to look at all of your assets, all of your collateral, all of your liens, all of your outstanding debt, and decide if they're if they're comfortable being a subordinated debt or not. They can hold on to your stock certificates, so that's fun. And they don't have to be a second in line. They can take a first position. So that is a situation that can be really alarming because a lot of the outstanding loans that people have, their business loans, the bank says that they want to be in first position. And if they're no longer in first position, it can throw the loan into a technical default, which would accelerate those outstanding business loans. So, a lot of times the businesses, unfortunately, the businesses that end up needing to do 6166 are the type of business that operates on lines of credit. We're going to borrow this money to build our next widget factory. We're going to pay it off, and we're going to borrow more money to build the next thing. We're a real estate investment company or construction company. We have lines of credit to fund our next project. That's the situation where there's not a lot of cash flow. We're using that line of credit or the bank debt to run the business, and the IRS is going to say, your debt to capital ratio makes us uncomfortable. We'd like to be first in line in terms of creditors. And that can, if it doesn't trigger a technical default on your existing loans, it can make it really difficult to get a future loan. So that's
not only,
mm-hmm.
yeah, not only that, but like in the situation that we were dealing with, the individual was the brains and the really the visionary behind the operation. And so the IRS is also looking at, now we have this business that's been operating with all of this debt successfully with this person on the right side of the grass. If they're no longer there, now what? And so are they going to be as comfortable if the person was on the right side of the grass? So if you're doing your evaluation based on this person being alive, and now all of a sudden this person is no longer alive, and they're really the driver and leader of that business, you really have to take a second look at whether or not this is a viable strategy.
And I think that same is true with the bank. A lot of times these business owners have long-term relationships with the bank. They're friends with the bankers. They've been doing business with them for a long time. The bank in that situation, while the business owner is alive, might be comfortable doing something that they're maybe not going to be comfortable doing if the person isn't there anymore. This is the guy we've worked with for 30 years. He always pays his debts. We're willing to color outside the lines a little bit while he's around. But if that business owner has passed away, then the bank is also going to be uncomfortable with the viability of the organization. So again, it could jeopardize the existing loans and the ability to get new loans. So the one of the families we were talking about, Ryan, I think they called a couple of their banks to say, hey, would you mind if the IRS took a first position as a creditor and you took a subordinated position? Would that be okay with you? And I think the banks laughed at them and then hung up. So, all right, we've talked a lot, Ryan, about a couple different examples and clients we've worked with that have thought about using 6166, and you have a real life case study now for us, right?
Yeah, but there was one anonymous or a question from one of the attendees with the delays in the responses from the IRS. What's the best practice if the IRS hasn't reached out related to whether the election has been accepted before the interest payment is due before the after the filing of the 706?
I would say that your best option is to act as though they've accepted the election and make that first interest payment so that you don't start off in technical default because you're waiting to hear from the IRS.
I agree. Perfect. So
Okay.
the case study that we'll just go through the client fact pattern. This is Angela. She's a single female who's about to be married, but with a very, very strong ironclad premarital agreement. But she's 52 years old. She's got an estate of $177 million. The total business value is $121 million. She's got a note receivable from a large defective trust sale that they did for an estate freezing strategy of $40 million, real estate assets of $5.5 million, liquid assets of $14.5 million, and then some miscellaneous other assets and about $3.7 million in debt. And so what they were looking at is solving this estate tax issue because she's got a fairly large estate tax. She's an inactive member in the business. It's a family-owned business, and she's in the next generation and has a minority interest in the business. But they were looking at whether or not, because she's semi-active, if you will, and so they were looking at can we make that argument? But they wanted us to do an analysis, and the analysis that we're looking at, we've done it because we had a very detailed financial model, as some of you know that we are famous for doing. But we've got an average annual growth rate of 5% on all the assets, so nothing too crazy. And Angela has all of her estate tax exemption, and for the assumptions that we've used, we're using a 2.5% annual increase for inflation. So not the current inflationary increases that we're seeing today, but we're looking at this over the next 40 or 50 years. So we want to use something that's reasonable. Also, we're assuming that they maintain a minimum cash balance of 5% of her illiquid assets or illiquid net worth upon her passing. And this is an important one for them, because what they don't want is to assume if there's a $50 million estate tax and we have $50 million in cash, that we use 100% of that to pay the estate tax, and now the estate or the next generation is left with a cashless or cash poor estate. So just a minimum cash balance was the desire by the planning team and the family group of 5% of her illiquid assets. And again, as I stated before, they wanted to look at all options for this ever-growing estate tax issue, including 6166. So when we take a look at the estate tax analysis itself, again, her current net worth of 177 million minus the exemption. So we've got a taxable estate of just under 165 million. So we've got $66 million in estate tax. And so then we also take a look at the estate liquidity calculation. So we take that $65.9 million, we add the minimum cash balance of the illiquid assets, which is $8 million. So when you look at it on a relative basis, making sure that we've got at least $8 million in cash in a $177 million estate, it's not a lot. It sounds like a lot, but it's if you look at it on the surface, but relative to the estate size, especially if we start to look at this, we looked at this at her age 52, 72, and 92. So projecting forward at age 72, that's 18.8 million on a $454 million estate, not a lot. But then again, the gross liquidity need is 74 million and change. And then we've got total liquid assets projected to be 17.7 million. So our deficit or our surplus calculation that we do at the bottom is today there's a need for about $56 million of liquidity. When we look at this going forward over 20 years, it's going to double, and that's under very modest growth assumptions. And at her life expectancy, that deficiency is at $250 million in assets. But if you look at the estate taxes, nearly $500 million, because we're at 1.1 billion in total estate value. So the problem just continues to compound and get worse and worse and worse. And so just leaning on a postmortem strategy is not a real viable solution. We need to do things. This looks like, and especially with a really active planning team like this individual has, we're getting married to a lifetime of planning, estate freezing techniques, gifting strategies, so on and so forth. Kristin, anything to add there? Okay.
Nope.
So,
yep, I think you got it.
Sorry for turning my the camera off. I start looking like a kung fu movie after a little bit because I've got some sort of relay issue on my computer. So when we do the estate tax payment analysis, this was something that the planning team asked us to do. And again, like I said earlier, we're going to look at bank debt. We're going to look at the use of cash, using 6166, and also using insurance, life insurance, because that was one of the strategies and why we were brought in, both for our modeling capabilities, but then also to evaluate the viability of using insurance as a potential solution to liquidity shortfall that they experience. And the amount that we're looking at, or the death benefit they're projected on all of the strategies, we're using the same base amount at life expectancy of $58 million, $58.634 million. The bank debt, we're going to make total payments on that 58 million of $96 million. And so, but on a present value basis, because we're assuming that that debt does not get incurred until she passes away. And we're assuming that she passes away at age 91 on a present value basis, assuming a 4.5% discount rate is 13.3 million. So if we look at the cost of $1 of paying estate taxes with bank debt, it's $1.64 actual, but on a present value basis, it's still 23 cents for every dollar of estate taxes. If we use cash, then it's going to be $58 million because it's $58 million in cash. However, we can look at it and discount it again using a 4.5% discount rate of $10 million. Again, cost of $1 is just $1 because I'm using $1 of cash. And then the net present value of that cash is 17 cents. But there's a big issue here. We don't know when she's going to die. If she dies next year, we only have $10 million if we use that present value calculation. Every year it gets bigger and bigger and bigger, and we have to have that source of cash in order to use cash to pay the estate taxes. The more viable strategy to cash is 6166. And again, what we're looking at is that total of 14 years of deferral. And we're doing interest-only payments during the first 5 years, and then our deferred principal and interest payments thereafter using a static interest rate. But again, as Michael and Kristin so aptly talked about, this is a variable interest rate loan, so it's going to adjust each and every year. But under the static assumptions and under pretty favorable assumptions today, the total payments are 76 million bucks. The net present value of those payments is 9.4 million. So it's about 16 cents on the dollar on a net present value basis. So on the surface, it looks attractive just from a pure economic perspective, but then you have all those gotchas that Kristin just went through that you have to be concerned about that make it potentially not a viable strategy for a family group. The last one is life insurance. And so in this case, the total payments is $6 million or $300,000 a year over a 20-year time period. And so on a present value basis, it's going to be a larger relative number to the actual cost because I'm making the payments starting today. So 3.9 million. But it's 7 cents on the dollar on a present value basis. So even though we're having to pay those payments today, and I don't have the use of that cash, it's 7 cents on the dollar. So these are, for instance, 6166 is 242% more expensive than the insurance. Cash is 258% more expensive, and the bank debt is 343% more expensive. The other thing that a lot of folks don't account for, specifically with accumulating cash in the estate to pay estate taxes, is that cash inside the estate to pay estate taxes is also subject to estate taxes. So is it all the cash? You know, it's almost like you're having to double bonus an employee to cover their taxes. It's the same type of calculation. Plus, if you're just going to maintain liquid assets to pay estate taxes, you may have a lost opportunity on that cash. And the most important factor is we don't know when Angela is going to die or when the client's going to die. And so that's one of the, life insurance isn't the be all end all. And we need to combine insurance with a lot of really good, sound estate freezing techniques and other things. But it is a very simple solution because it is a certain event at an uncertain time. We don't know when somebody is going to pass away. And so is it going to be the best investment that this family group has ever made? No, it's not. But I can guarantee you it's not going to be the worst investment. So it is a viable solution or a viable strategy. Any comments from the two of you?
Yeah, I don't have a comment on that, Ryan, but I had a really good question. Is there a business value, or I suppose even a size of the estate, where insurance no longer makes sense. An example, $1 billion plus either net worth or business value.
Chris?
So I would say no. There's certainly a size of the estate where the life insurance ends up being a really small percentage of the estate, and it doesn't, depending on the type of assets, it's probably not going to perform quite the way you want to. But I was thinking back to situations in 2010 where for a brief moment in time, there was no estate tax. And I had some clients pass away at that time, and they had life insurance, and not one of their heirs said, "Oh man, I wish we didn't have that tax-free liquidity that we got from the life insurance. That was a bad choice." So I think that even when you have $1 billion, having that liquidity that you were able to buy at a pennies on a dollar cost, as Ryan just illustrated in this, is always going to be additive to the situation. We hold the life insurance outside of the taxable estate, so it's not going to inflate the $1 billion estate, and you've got that liquidity. You can transfer illiquid assets into a trust in exchange for the cash. It just provides additional flexibility and optionality at a relatively small cost.
The other thing is it's not just an expense, and that's what we have to really get family groups to understand. And we even have totally liquid family groups that use insurance as an asset class, a non-correlated asset class, as a part of the overall wealth management situation. So you're gonna get somewhere between a 4.5% and a 7% IRR on the premiums versus the death benefit at life expectancy. So not that great. And first of all, you got to die to collect. So there can't be anything worse than that from an investment perspective. It's really for somebody else. But it's income tax free. And for most of our clients, they're in the highest marginal tax rate. So that's 40 to 50%. It's estate tax free. So that's another 40%. And if it's structured in a multi-generational trust, it's GST exempt as well. That's another 40%. And you can multiply that times 3 or 4 generations if in fact it's in a dynastic trust structure. So insurance can be a good asset for any family group to utilize, but it's not the only solution. I would say where you start to get, and the capacity question is something that we get because we've been asked to go out and secure max capacity cases. So for that specific question, it really depends on the age and health of the individual, but somewhere between 300 and 400 million is the total amount of capacity that might be available on a single insured. Once we start looking at single life survivorship, so on and so forth, and we exhaust reinsurance markets, we can potentially get higher than that. But again, it's on a case-by-case basis. And then you just let the math do the talking. We have a saying in our office, numbers don't lie, people do. And so just look at the numbers and make an unemotional decision. So it can be a viable solution on a go-forward basis.
And Ryan, there were 2 interesting questions that came through that I wanted to take a second to address. One was, can you have life insurance and still do a 61-66 election? And absolutely, as Brian just said, we're going to own the life insurance outside of the taxable estate. And remember that the business has to be at least 35% of the overall taxable estate. But let's say the business is 40% of the estate. So you meet the threshold. You still have 60% of the estate that's non-business assets that's also subject to an estate tax. So having the tax efficient liquidity of the life insurance will just help the situation, because you are going to you can't defer the tax on the non-business assets in the estate. So yes, life insurance and 61-66 can go hand in hand. The other interesting question was, how are you going to pay for the life insurance? And that is probably where we all get excited about the planning strategies. We would use lots of other planning strategies to freeze the assets in the estate, shift appreciation out of the estate, and then at the same time, those strategies shift liquidity into the trust, and we use those to pay the premiums on life insurance. We might borrow from a bank. We would use maybe an installment sale or a GRAT to pay premiums, split dollar. There are lots of different ways to efficiently pay a life insurance premium that are going to, at the very least, freeze the estate, and then other times can actually shift assets out of the estate.
I would say very rarely, less than 1%, probably less than 0.5% of the time, do we ever pay gift tax on a large premium. We're using usually excess cash flow from a defective trust sale or other assets that are already positioned outside of the estate, intra-family or intra-trust loans, bank loans. There's all kinds of really creative and clever ways to fund the premiums via cash flow outside of the estate. But very, very good question.
Right. And the other thing is we don't pay a gift tax usually because if you have available exemption, you have to use it. And most of us like to save the exemption for the estate tax. So that's another reason that, you know, it's not like we could make a gift and choose to pay gift taxes on it and save our exemption for death.
So the next page, Michael.
So this, I think we kind of covered a lot of this. You know, certainly the philanthropic strategies, that's one of the ones that, you know, life insurance is a great strategy for, where you can buy a bunch of life insurance inside a trust and plan to give your non-business assets to a charity or to your foundation and get an estate tax deduction and know that you have the life insurance to buy the business assets out of the estate. So those two combinations are really effective and don't require 6166.
And then Kristin, just real quick on that, a lot of times we'll see family groups, they'll use the insurance as a down payment. Maybe it might not be the entire amount to buy the business out of the estate. And while a charity can't own a closely held business, can it receive debt? Can it receive a note receivable? Is that a possibility or no?
No, we'd have to buy that note out quickly. Yep.
Gotcha.
But then there are the other advanced planning techniques that we've just talked about, and those are probably 1, 2, 3, 4 separate WPX90 seminars, installment sales, GRATs, split dollar, all strategies that transfer wealth that we can use to freeze the estate, shift appreciation, get liquidity into a trust. So, you know, there's a lot of other planning considerations, and one of the downsides that we referred to earlier with 6166 is that if you're like, all right, I'm just going to make the election in 20 years when I pass away, you're disincentivized to actually do planning because you want to make sure that you're not going to violate the 35% threshold. And so you're relying on a strategy that's not really estate or business friendly, that may or may not be effective and in effect at the time you die, rather than doing planning today that can actually help your client reach their goals for their family and their business.
And we've got to be careful as estate planning practitioners and advisors to our clients, that because they're always looking for the easy way out. And we've really got to be able to educate them. And that's one of the reasons why we felt it necessary to go through this presentation with you all, is to really educate you, because on the surface, it may look attractive. But when you look at what we learned today, there are the intended consequences of 6166, but there's also the unintended consequences and the gotchas that we need to be aware of, and make sure that our very savvy business owners go in eyes wide open and understand what could go wrong, and is this really a viable strategy. So again, just doing a overview of the learning objectives. We provided our overview of 6166 to find the unintended consequences when utilizing the strategy, the client situations where it should and shouldn't be considered, and even looked at the different strategies to pay estate taxes. We've got a couple of questions that were, and please feel free to type any additional questions that come up. But Michael, do you want to feed these questions that we have?
Yeah, I'd be happy to. Yeah, we had a few questions that came in. First one was relating to the lien, Kristin, from the IRS once you elect 6166. How long does it take for them to start the lien process? Do they do it after an audit? Do they do it after, is there a closing letter that the IRS sends saying, we accept your election and here's the lien? What does that look like?
So what you have to do is when you file your estate tax return, you make the election, and you can actually, what you're making is basically a protective election, because you don't have a filed determination of value, but you put in a lot of information, including the executor's reasons for thinking that 6166 is a viable option for the estate. You reach the 35% threshold, you have an active business, all of that. And then you have 60 days after the final value is determined to actually start paying the taxes. So they do give you some time, particularly if you make that election in your timely filed return. So that's part of the process.
Perfect.
Mm-hmm.
The next, or the other two questions were getting back to the active versus passive interest here. One was, if you have a shareholder that's in a closely held S corporation who's not an employee and they're a minority shareholder, would you say that that's a passive or an active owner? And then obviously, would that qualify for 6166?
So, I mean, we would probably need a lot more facts, but if we presume that they inherited the minority interest from generation one, the generation two, they have no involvement in the business. It's an active business, but all they're doing is getting S distributions. They couldn't even necessarily tell you what the business does. Then you're not likely to be able to say that this is an active business interest. If you're a minority interest and you're not involved, you don't work for the business, but you're involved and you sit on the board, or you're involved in the business somehow, then you maybe could make that argument. And that goes back to what I was just saying about the executor, when they file the election, has to include a statement as to why they think that they qualify. And so part of that would be, this is really and truly an active business interest because of X, Y, and Z. And then the service makes that determination. So
perfect. Is there a look back time, Kristin, on the whole idea of active versus passive? You mentioned earlier about, if somebody had a stroke, right? And then presumably between that point and if they pass away, it would be very difficult, I would think, to say that they were active, right? If they had something like that happen. But if they were active before that, is there a rule of thumb, or is there a time frame that is applicable for looking back, right, to qualify?
There's nothing specifically stated in terms of a rule of thumb or a look back period. The service doesn't necessarily want to box themselves in. So that again is part of the statement that the executor makes. They had a stroke, 60 days later they passed away. They had a stroke, 8 years went by. That's a different situation. And so again, it's facts and circumstances driven.
Sure. And then I thought this was a really great question. If you plan on using 6166, or it's your only method because maybe you didn't plan around it and it's denied, is there a penalty, or do you just pay the tax, or what happens at that point, right? Or I suppose even if it's denied, or you just don't qualify, right? What happens then?
Right. So, I mean, you've made the protective election. The service has made the determination. You are not, I would say you're not in violation of the tax rules at that point. You've set out, this is why we think, this is how we're going to pay, this is how long we're going to go, this is when our first payment would be due. And then during the course of the negotiations, the service determines you don't qualify for whatever reason, then your tax is due. But you didn't, because you made that protective election, I would say that it's unlikely that they're going to assess penalties because you didn't, pay your tax up front. If you had a valid reason for thinking that you deserved it.
Sure. Perfect. And then the last question that we had in the chat, if the estate tax return is being extended, is there a need to attach some sort of a statement with the extension indicating that we're going to defer under 6166?
So it has to be attached to your timely filed estate tax return. And so if you have a valid exemption, I would say that you would just attach it to your return when you're actually filing it.
Perfect.
We
And then
got one more.
Yeah, last question here. And it looks technical, so bear with me here. Revenue ruling 23-2. Has this impacted any of your clients' existing irrevocable trust strategies? My brief review of this ruling seems only to clarify what was already the case, that completed gifts to idiots or potentially defective grantor trusts that aren't otherwise includable in the estate of the settlor won't get a basis adjustment at the settler's death. Realize that's a very detailed, nuanced question there. But any thoughts on that, Kristin?
Yes. And the question of basis adjustment is one that tax lawyers have had fun debating over drinks at Heckling for years in and years out. But I would say most of the people felt that you don't get a basis adjustment, that you sold the asset to a defective grantor trust. You didn't claim any basis adjustment at the time that you sold it. There was no capital gain to recognize. And the fact that now you're dead and you're no longer a grantor trust shouldn't trigger a basis adjustment. It's not included in your estate. And so, there were some really clever arguments to try to get you to the place of it's not included in your estate, but you still get a basis step up. I'm not sure that those really had a lot of legs. And so it's not, it doesn't, as far as I would say, impact the planning involving digits. It just gives you a little bit more certainty that the thing we thought was the case. You sold your asset to the trust, it's out of your estate, appreciation's out of the estate, and there was no capital gains to recognize at the time of the sale. Those were 3 wins. And so that should be, sufficient for you.
Perfect. And just to wrap things up, Michael, if you'd like to contact Michael or myself to brainstorm a client matter or to evaluate different strategies for estate planning or paying the estate tax, please feel to contact us here. And then also please visit our website at www.wealthpoint.net to see other upcoming events. We've got an upcoming event in November where Ben Rainey and Frank Hirsch will be speaking to the issue of private placement life insurance and private placement variable annuities and all of the different nuances surrounding that strategy. So we look forward to seeing you all then, hopefully. And thank you so much for taking the time to sit with us today. Just as a reminder, email Kristin at wealthpoint.net with the information regarding your CE requirements or questions or requests. And then also please complete the survey that will be emailed to you after the presentation. We will be emailing a copy of the presentation, a copy of the recording, and then also the source material from Checkpoint backing up all of the information that we shared with you today. So you'll have all of that information after. Please feel free to share it with colleagues. And again, thank you so much. And thank you, Kristin. And thank you, Michael, for sharing your time and wisdom with us. I think this was as riveting as 6166 could get, which is not that riveting. So anyway, thank you all.
Thank you.
Thanks, everybody.